shoulder, head, shoulder. I like the fact that if we look at Bitcoin, how has Bitcoin performed versus gold, silver, and the stock market over the last week or two? It's actually outperformed. So I'm taking those as breadcrumbs telling me, okay, there's something going on here. There's rotation of capital back into Bitcoin in the near term. And maybe we're due for a run up to about the 71, 72,000 level. And that's actually what the target would be, the calculated target of this inverse head and shoulders. So I am bullish on Bitcoin here, at least in the near term. If it ever takes out the 58,000 level to the downside, then I would have to flip back to being bearish for a move down to 50,000. But right now, this is a very bullish pattern on Bitcoin.
For much of this cycle, Gareth Soloway stood apart from the crowd. While Bitcoin bulls projected six figures and social media celebrated every breakout, Soloway repeatedly warned that the near-term risks remained elevated. He maintained a cautious stance even as many of the industry's biggest names called for higher prices. That consistency earned him criticism from some corners of the crypto community, but after nearly 3 decades in the markets, Soloway has learned that conviction means very little if the charts disagree. Now, however, something has changed. Bitcoin has quietly begun outperforming gold, silver, and equities. Institutional capital appears to be rotating once again. The Federal Reserve may be closer to easing than tightening. And with recession risks building beneath the surface of the global economy, Soloway believes we could be witnessing the beginning of a major shift not just for Bitcoin, but for financial markets as a whole. Before we get to Soloway's surprisingly bullish Bitcoin outlook and his price target for the months ahead, his latest analysis begins with the macro picture, the Federal Reserve, interest rates, oil, inflation, and why an economic slowdown may force policymakers to intervene sooner than many expect. Make sure you stay until the very end, because every piece of this puzzle connects to Bitcoin's next move. And if you enjoy this type of macro and crypto analysis, don't forget to like the video. Subscribe to the channel, turn on post notifications, and let us know in the comments what you think about Gareth Soloway's analysis.
The data that I'm looking at and just knowing how the Federal Reserve operates is they're talking a tough game here. I would at most expect one rate hike the end of this or later in this year, and possibly no rate hikes and even cuts as early as next year. And so I get that, you have Kevin Warsh coming out and talking real tough. He obviously has the Fed board that votes on rate hikes, and they're still talking tough. But in my humble opinion is he is going to fight rate hikes very harshly because of the Trump appointment. He has to kind of answer to the president, as weird as that sounds. I know he's supposed to be independent, but at the same time, Trump was very clear that he was not going to be appointing anyone who was going to raise rates, right? And he always, think about what the president says. Anytime we see the stock market selling on good economic news, he has an issue with that. He takes an issue with that because he says, well, this is good. It should make the markets go up. And so it's very unlikely that we will get rate hikes, maybe one this year. But with my analysis showing that we're likely going to see an economic weakness towards the end of the year, it could pivot very quickly towards cuts in 2027. So when we talk about rotation, the way institutional money works is this, is that institutions, the hedge fund managers, they make $0 if the money is sitting in cash. So they are pushed by their own want of making money to always have money deployed. The only time they sit in cash is if the stock market is collapsing and it's all out panic, a la January, February, March of 2009, where they were just out of it. They were just like, you know what, this is too dangerous. We're going to step aside. In this environment, they're not going to put money in cash. They've got to deploy it. So when they're pulling money out of semiconductors right now, they're actively saying, well, where can we rotate that capital into? And that's names like Apple, which has made new all-time highs. We've seen Microsoft, Meta bounce. I mean, a lot of the ones that were weaker, that we're actually seeing money go out of, the money was being sold out of Microsoft and Meta, and it was rotating into semiconductors. That money is now flooding back into the likes of Meta and Microsoft. Now, again, as we bounce, we should see Apple, for instance, come back in a little bit. But for the most part, that's the thought process in this environment where we're not in a bear market, you will see rotation of capital, not as much of just leaving the markets entirely. The old adage, another adage is that where the semis go, the markets follow. And I think that's very true right now, is that, yes, oil has come way down, which is helpful for inflation and the Fed maybe not having to hike, but now we're seeing oil go back up. And now maybe the Fed might be forced to hike anyways. But you still look at the markets, and the markets today are down. Why? Is it because oil's up? Or is it because the semiconductors got hammered early in the day and now semis are bouncing, the market's bouncing? And so I would say that I think there's a point here where the biggest risk for oil is that the price up on oil causes inflation, which eventually causes a recession. And that is the killer. That's the one. When we start to hear that word recession and we see growth slow, when we see jobless claims start to spike, when we see the jobs data start to get, in terms of losing jobs, worse, that's where the price of oil is going to be scrutinized and mean much more. At this point, I don't think that a lot of this volatility recently is because of oil, just like we didn't see it back when it was north of 100, having a massive impact on the volatility in the markets.
Would it change your view on the Fed policy, which we talked about earlier, their willingness to hike rates more than once if we see oil continuing to go higher?
Yes, I do think so. So there's no doubt about it, is that if oil pushes back north of 100 and stays there, that's going to have a longer term impact on inflation, and the Fed probably would have to act in that regard. I don't anticipate it. I've already, so one of the things here is there's a gap fill right here on the chart at around 67. That's exactly where price went. And then we've gotten this move. I plan to short oil if it gets up to about 87 right here. I still am in the camp that the president is very hyper aware, as we saw by his speech last night, that the midterms are coming up quickly, and he is going to do whatever he has to do to get that oil price down. So if we get to 87, I'm going to short it. I think we come right back in. I do not anticipate oil going back above 100 this year. I would be very, very surprised. And you can hold me to that in our next interview, that if oil goes above, I'd be wrong. But I think it stops at 87-ish or so. And I think by the midterms, we're back to the 60s.
What makes Soloway's latest outlook particularly fascinating isn't simply that he's bullish, it's that his thesis depends on several dominoes falling into place simultaneously. In his view, the market is overestimating the likelihood of aggressive rate hikes while underestimating the possibility that economic weakness forces the Federal Reserve to pivot over the next 12 months. He points to a growing disconnect between the headlines and the underlying data. While policymakers continue to talk tough on inflation, markets are beginning to price in a different reality, one where slowing growth, weakening employment data, and political pressure eventually outweigh concerns about keeping rates elevated. If that happens, liquidity conditions could improve dramatically. And that's where things become particularly interesting. Because if oil remains contained, recession risks continue to build, and yields begin drifting lower over the next 3 to 6 months, the environment that emerges starts looking increasingly favorable for risk assets. Which brings us to Bitcoin. After spending years warning investors about downside risks, Soloway now says the charts are telling him something entirely different. And perhaps more importantly, the capital flows appear to be confirming it.
Well, let's talk about Bitcoin then. Right now, 63,000. And similar to gold, it's been trading range-bound here. Is this a bottoming pattern for you, Gareth?
It is. It is, at least in the near term. And listen, a bottoming pattern can fail if you ever take out this low here, which is the head of an inverse head and shoulders. It's a bullish pattern in technical analysis. Then it would negate the pattern. But until then, shoulder, head, shoulder. I like the fact that if we look at Bitcoin, how has Bitcoin performed versus gold, silver, and the stock market over the last week or two? It's actually outperformed. So I'm taking those as breadcrumbs telling me, okay, there's something going on here. There's rotation of capital back into Bitcoin in the near term. And maybe we're due for a run up to about the 71, 72,000 level. And that's actually what the target would be, the calculated target of this inverse head and shoulders. So I am bullish on Bitcoin here, at least in the near term. If it ever takes out the 58,000 level to the downside, then I would have to flip back to being bearish for a move down to 50,000. But right now, this is a very bullish pattern on Bitcoin.
Okay. Let's end on key levels for the asset classes that we're talking about. So S&P 500, what are we looking at here for the next key levels, Gareth?
So the big level, we talked about it just a little while ago. This one right here at 7,300, guys. As long as the S&P stays above 7,300, I would maintain a bullish bias on the S&P, maybe a little bit more neutral to negative on the NASDAQ because of the tech side of things and the unwind there. But that is your line in the sand. If we break below that, you should head straight to 7,000 because that, again, would be your high pivot from last year. And again, if that breaks, we could be looking at as big of a move down as 6,300 and maybe below. But let's start with that 7,300 being the key level. Which one do you want to do next?
Yeah, NASDAQ as well.
NASDAQ composite. Let's take a look. So the NASDAQ composite, short term, we very clearly see you have a low pivot right through here at around 25,000. By the way, that's incredible that it's literally at the even number of 25,000. So it's come down to 25 and they've held it above. Come down again, they've held it above. If 25,000 gives way, it's going to act like a dam breaking, and you'll see price very quickly decline all the way to 24,000. So about 1,000-point drop there on the NASDAQ. So watch 25,000. Stays above, there's still hope for further bull market action. If it breaks 25, should be a very quick flush to 24,000.
My questions for gold and Bitcoin, similarly, what would happen if the floor that they're forming right now is broken? So for gold, that's 4,000, and for Bitcoin, that's 60,000.
Yep. So if you take out this 3,900 to 4,000 level on a breakdown below this wedge trend line, you're going to head all the way down to this support at 3,500. 3,500 for me would be where I start loading up on long-term holds. I already have some long-term holds that I've held for years and years. This would be my buy and bull opportunity. So watch the 4,000, 3,900 level. If it breaks, goes to 3,500. On the other side, the wedge pattern can break to the upside. If we take out 4,150 or so, you could be headed back towards 5,000 in very quick order. So the wedge pattern, remember, it's like a pressure cooker. It's squeezing price. If it breaks one way or the other, you're going to get a big move in that direction. The yields for me, I think a lot of this hype about the Fed hiking rates, I don't expect it to happen. Again, maybe one rate hike, but with where the 10-year is already trading around 4.5%, it's already factored in for the most part. So I don't expect it to go much higher. And I think, again, with the economy potentially weakening later this year, it's very likely we could start heading down on yields over the next, let's say, 3 to 6 months.
There is an old saying on Wall Street that fortunes are made during periods of uncertainty, not certainty. By the time everyone agrees on the direction of a market, the biggest gains have usually already happened. That doesn't mean Soloway is guaranteeing Bitcoin's next move, far from it. Even he acknowledges that a break below key support levels would invalidate his thesis. But for the first time in a very long time, the evidence appears to be shifting in favor of the bulls. Think about what we're potentially looking at. A Federal Reserve moving closer to cuts than hikes, falling yields over the coming months, institutional capital searching for new opportunities, Bitcoin outperforming traditional safe havens, and an asset class that remains tiny relative to the global pools of capital waiting on the sidelines. If these trends continue to converge, the next phase of this market could arrive much faster than most people expect. More importantly, investors should recognize that preparation matters more than prediction. The people who benefit most from major transitions are rarely the ones reacting after the headlines arrive. They're the ones who spent months paying attention while everyone else was distracted. Whether it's Bitcoin, Ethereum, infrastructure plays, tokenization, or the broader digital asset ecosystem, the window to position yourself for what comes next may be significantly smaller than it appears today. Because this isn't just a conversation about a single price target or whether Bitcoin reaches $72,000 in the near term. It's about understanding the larger shift underway. Markets are changing. Monetary policy is changing. Capital allocation is changing. And if history is any guide, those changes tend to create entirely new winners over the decade that follows. The next few months may ultimately determine whether Gareth Soloway's latest call becomes another controversial prediction or the moment one of Wall Street's most persistent Bitcoin skeptics correctly identified the start of the next major move. Either way, the breadcrumbs are there. The question is whether investors are paying attention. If you enjoyed today's analysis, make sure to leave a like, subscribe to the channel, and share this video with anyone trying to understand where Bitcoin and the broader financial markets may be headed next. Turn on post notifications so you never miss an upload. Thanks for watching, and we'll see you in the next video.